And good morning. My name is Robert Newman. I am the Tax Director of Carter, Collins and Meyer, UK-CCM.com, a firm of accountants in Rochdale, Lancashire, Greater Manchester. I specialise in the tax part of the firm, and we look after nearly 2,000 clients across a range of industries, disciplines, sizes and shapes who are in one way or another in need of taxation advice or compliance. Today's particular topic for those joining on this webinar is family investment companies and their use in inheritance tax planning. This can be quite a dry technical subject. I make no apologies for that. There is some detail as we get through, so I do have a set of slides that I think are appropriate to be used today. I often try and avoid using slides for the reason that they can be distracting from the material being delivered, but I think they actually add for today. A recording of this webinar will be put up on YouTube together with the ability to download the slides as a PDF document. I intend to use this presentation in other formats as well. This is a subject that those who have an interest in do ask me about fairly regularly. In so doing, they will be referred to this particular video. It is a live broadcast and there'll be minimal editing to it afterwards, so any mistakes I make along the way, please forgive me. I also will be taking occasional slurps of coffee needed at this hour of the morning, particularly talking about a subject like this. So without further ado, I think it's time to probably share my screen. Oh, I suppose the final thing to add to it is I will be answering questions as we go through, and being a live event. I think there's a couple of people on the call at this stage, so very happy to take any questions they have. So here we go, share screen, and we are on. Hopefully you can still see me. If not, well, hey ho, you've lost my wonderful mug for the duration of this. Family investment companies, February 2021, Carter Collins. Yeah, right. Family investment company. So what is a family investment company? Well, it's a posh term that's being used for something that's actually quite simple. Strictly, it's a bespoke vehicle which can be used as an alternative to a family trust. Trust law is ancient as law goes. A lot of it is quite old-fashioned in the way it's written. Yes, they do have uses. Yes, they're not something that we tend to use very often, I have to say. As part of will planning, we will write will trusts into things. Discretionary trusts are used, but almost all other forms of, well, there is only other one form of trust strictly, I suppose. But a lot of the stuff that's talked about trust, we don't tend to use, we don't tend to see them as a methodology or a vehicle for inheritance tax planning. They are more, as far as we are concerned, I am concerned, a method of asset protection and control of assets as opposed to tax planning at this stage, particularly when you look at the potential lifetime charges, the 10-year charges, etc., that are put on them. It's less common than it certainly once was. When I first came into accountancy in the 1990s, I worked for a firm that had been very established, been going forever. We had a lot of trust funds in those days at that firm because families had made settlements in previous years. If you have existing trusts, they all have a life on them. There's one or two old ones left lying around that may not, for the real techie amongst us. But the family investment company is, in my view, a modern version of this using modern legislation. What it also means is it's based around limited companies, just good, old-fashioned, boring limited companies that any high street firm of accountants can administer and take care of. If you put these in place for your planning, you don't need to be using Carter, Collins and Meyer once the planning has been set up, although we would be delighted to look after you. You can readily take the created entity with its articles, memorandum of association, shareholders agreements into any firm who will be able to administer and look after it. That said, I did a couple of things in there: the articles, memorandum, and bespoke shareholders agreement, all of which are needed. To get this to work properly and to be used properly, you do need to bespoke a lot of these documents. A company form straight off for 12 quid, as you can get them nowadays, is not going to give you the results that you want. And I would urge people not to DIY this process. If you have stumbled across this on YouTube and decide that, oh, that looks exciting, why do I need to pay out fees? I think we as a firm haven't had any significant challenges from HMRC at this stage. That may or may not change in time. There may be some more challenges. Hard to say exactly what HMRC will do. You are using very established legislation and rules, so not sure where the challenges are unless you get into some of the esoteric thoughts of family investment companies, which you can find on certainly larger firms of accountants' websites who have some funky things they do with them. We don't tend to do that. We tend to be fairly conservative in the use of them. The structure around it, though, does need to give them some thought, and I would definitely talk to a accountant or solicitor who is familiar with this. Depending on how you use it, you will need both. Again, if you're using Carter Collins, we are quite happy, or CCM, we are quite happy to work with your existing accountants and lawyers, or alternatively, we can introduce others to you and bring you into our wider network. The key thing of an FIC, a FIC, is to remove assets from the individual's estate and put them into a corporate wrapper. In so doing, it allows them to be held in ways that create the opportunity to pass them through generations outside of inheritance tax if done properly. And if you really are really keen to get into how that's done, I can tell you now, you can probably stop watching the video. Essentially, you create a PET, a potentially exempt transfer. Now, under existing rules in Feb 2021, PETs work on the basis of the 7-year rules. I think I touch on this later through the slide, so I won't get too much into it. That is always subject to change, as is always with tax planning. There is rumours and talks that to pay for coronavirus, it will be changed. We will see. What it also does is a FIC. It allows the original generation, which I think through the slides I refer to as parents, to retain control over assets while accumulating wealth in a tax efficient manner. We reinvented FICs, looking at incorporation of property portfolios, and in so doing, I went, oh wow, this could save inheritance tax, and started doing some inquiries and investigations, and realized that many other people had actually already got there before me doing something similar. I did have an earlier version of this for those of you who may know me and talk to me using LLPs. Yeah, I gave up after a while doing that because I believed that was more contentious and likely to be challenged. The limited company one, not so much so. So getting into some of the detail. Structure one of family investment companies. Example of a structure could be as follows. The parent provides funds to the FIC in the form of either an interest-free loan or subscribing for preference shares. This will not be regarded as a transfer for inheritance tax purposes, and these funds can be extracted at a later date tax-free. The parent also subscribes for voting shares in the FIC, which gives control of the company at shareholder and board level. The parents could also subscribe for non-voting shares. Parents can then choose to give these non-voting shares to their children, preferably before significant asset values have occurred in those shares, minimizing the value of the pet. And the gift will not be subject to IHT, provided that the parent lives for 7 years from the date of the gift, as it has created a pet. Non-voting shares may pay dividends in the future. The parent can also put funds into a discretionary trust for the benefit of minor children without triggering an IHT charge, to the extent that their nil rate band and annual exemptions are available to them. The parent should be irrevocably excluded from the benefit of this trust. The trustees then subscribe for a class of non-voting shares in the FIC at market value, i.e. nominal value if the shares are newly created. So you create a form of limited company that has different classes of shares. In the initial stages of this, if you are trying to accumulate new assets for the future, funds can be put into that in the form of an interest-free loan or preference shares so that the funds can be clawed back later. If you have existing assets, we would look at taking you down in corporation relief, section 162. That includes property under the Ramsey rules that would allow you to get the property into the limited company. But again, you would still be looking at creating voting and non-voting shares, having bespoke articles, memos, and shareholders agreements, and then gifting out the non-voting shares. Fundamentally, that's it. You are wrapping up stuff in a way that allows you to gift it. But what you are then doing is keeping the assets, the underlying assets within a limited company under the control of the voting shareholders, that allows those voting shareholders to determine what happens to the income from the shares. I.e., let's take the easy one. You've got a property portfolio, you've got 10 properties, you incorporate them, you create the structure. The substantial part of the value of those properties could have already been gifted away in non-voting shares, whilst the rents received from them is controlled by the voting shares, who determine who gets dividends, when, what, how, so that mum and dad can still get income from it. Part 2, the company could be set up as a UK unlimited company if you wanted to keep it out of the requirements of large company turnovers, or large company regime. So potentially there is some compliance costs if you have asset values that exceed 5.1 million and turnover of 10.2 and 51 employees. I don't come across cases of that scale. Asset values may well be more than 5.1, but they don't have the turnover of more than 10.2 and 51 employees. So it's kind of a moot point, but a techie one for those of you interested. Unlimited companies, if you go down that route, won't have the same protection from creditors. Again, it doesn't tend to be an issue with the planning that we undertake. Most assets within FICs are going to be, if they have already, if there's no existing finance on them, well, there's very little in the way of creditors. If they have existing finance on them, there'll be specific charges anyway over those assets, and the creditors already have their security. So I don't see that as a particular concern for this one. Structure 3, capital gains is realized by the company. Capital gains realized by the company are chargeable to corporation tax at 19%. I did prepare this slide a while ago that said it fell to 17. It hasn't. This is lower than the current rate of capital gain, marginal rate of capital gains tax of 20% that would be payable by an individual. What I'm trying to say here is, let's say there's an active share portfolio undertaken by a family has an active share portfolio. It is included within this. Gains and losses on that currently, and again, CGT subject to review, would be chargeable at 20%. In this spaces, though, it could be 19%, albeit that that's then within the corporate wrapper, and potentially further charges are arising as and when things are removed. But companies, you're paying under corporation tax rates as opposed to individual. In addition, where assets are held prior to the 1st of January 18, indexation allowance will be available to reduce the gain or charge to the tax. Not going to apply to if you're creating this new. Where the assets disposed of is shares in a subsidiary company, substantial shareholding exemptions may apply. Again, if you're creating group structures using this, you are into being able to look at trading company rules. Again, this is a technical point for those interested, not going to be massively applicable to this. If you are looking at this from a buy-to-let portfolio point of view, which a lot of you on this call live will be coming at it from the Society of Will Writers, and therefore thinking in terms of planning your family's estates for existing assets held personally. Proceeds from the sale of investments can therefore be reinvested in the company, lower taxes than individuals. Okay, again, slightly moot point for many. 4, the company will be able to claim corporation tax deduction for interest on loans taken out against the value of the investments, where the loans are used for the purposes of the company's business, e.g. acquiring new shares or generally managing its business. Loan interest deductions may be restricted where the total interest payable exceeds £2 million per annum on a group basis. Now, this is really, really important and the crux of the planning for the majority of the cases that I am involved with. Section 24, interest relief on buy-to-let portfolios. If you hold buy-to-let portfolios of residential property in your personal name, Section 24 means that you can only claim tax relief on 25% of the interest payable. In other words, you can only actually get interest at your marginal rate of tax at 20%. You are not able to claim a full deduction for interest on your buy-to-let portfolio. With a corporate, you can. So if you are thinking of either creating a new buy-to-let portfolio within a limited company structure so as to get the interest relief, or you have an existing buy-to-let portfolio where interest relief is a problem for you and you are thinking of incorporating it to avoid Section 24 charges, this is an effective method and creates a situation which would allow you to also plan inheritance tax by making use of a entirely uncontentious, potentially exempt transfer of non-voting shares in a limited company. Now, I sometimes have a way of showing this, which live I forgot about, but we'll do. And I show it as you create a limited company. This is it. It is a pack of paper. Following all the rules that you properly have to do in order to qualify for Section 162 incorporation relief under Ramsey. If you can demonstrate that property portfolio is actually a business and that you do actually work in it and subject to stamp duty, which we will come on to at some point in this, you can take all of this, you can split it into chunks. These chunks are called shares. Your whole company is now split into chunks, shares, and you can gift out sections of this to other people whilst retaining part of it. And the part of it that you retain is the golden share that gives you control over everything, so that all of the income that your entire thing generated can still be controlled by your golden share, but the ownership of the underlying asset can be split up between other people without having to change the title deeds. So if you think of it in a house, you can't readily gift parts of houses. residential buy-to-let, to other people because it affects the land registry and it affects the mortgage. Whereas if a limited company owns the house, the mortgage has to be in the name of the limited company, and it is the limited company who will be at land registry, which means you can change this around regularly without affecting either of those two. And you can get interest relief under Section 24 or outside of Section 24. This creates a very strong planning opportunity. Same applies if you want to do it for shares within the limited company. The same applies if you want to do alternative investments. We have a client who puts a substantially valued motorcycle into this structure. We have people who put all sorts of income earning assets. I wouldn't suggest using your own home this way. You create another load of tax issues, but you could look at doing almost anything. Jewelry, cash, as we've already discussed, property, furnished holiday let, for the inheritance tax point of view, not for the interest rate relief particularly. Almost anything. Everyone seems to be following along okay so far. Hopefully I'm not making this into double Dutch. It is still making some sense. Structure 5, expenses incurred by the company in managing its investments and in running the business will be eligible for corporation tax relief. This will include investment managers' fees and remuneration to pay to employees and directors. Certain items are not eligible for tax relief, such as entertaining. It's the standard limited company rules. What it can allow you to do is either by way of shares through dividends or in terms of salaries for work done is distribute income to family members. The obvious one in terms of dividends would be from a buy-to-let portfolio, would be to create the buy-to-let portfolio, structure it within this, do all the right things that you need to do, gift shares to your children, and your children who are now at university, you can pay them a small salary and give them dividends from the company directly to them, keeping them within tax-free tax boundaries, taking yourself out of higher rate taxes and funding their university education. The structure can be passed down through family members. Unlike trusts, which now being created have a lifetime of 125 years or less, this certainly at this time, and things are subject to future changes and all that, but this has no lifetime, no fixed lifetime to it, and it can be passed down. As I say, you can bring in new family members to it, you can bring in children, although you have to watch that the income from it is not then included as part of your tax returns, but you certainly as a way of inheritance tax planning, it would be a way of doing it. If you're trying to loop back to the slide, the expenses that can be offset, if you're looking at share portfolios or asset managed investments linked to the stock market, individual investors cannot obtain tax relief for expenses in managing his share portfolio, whereas you can if you've done through this. So if you subscribe to Bloomberg or buy journals or take it seriously, you're investing, you as an individual will not be able to get tax relief for those expenses, whereas you can through the structure, and you are taking it outside of inheritance tax. 6, shareholders themselves will be subject to tax on the extracted profits. Income on dividends, effective rate can be up to 38.1% depending on earnings. But from combined personal allowances, there is a significant amount. Essentially, you can get £50,000 out of this at 7.5% a year at current rules for 2021. That's pretty significant. You can get quite a lot of money out at pretty low rates. Okay, you have had the corporation tax to start off with, but even the combined rate between the two of them is a very effective income managing tool as well as anything else. Income tax on salaries, if you take salaries, yeah. CGT on capital distributions, again, works the same as limited companies. You wouldn't want to be winding up a family investment company because it kind of defeats the point. But if you'd reached that stage where you did, you would have to be looking at taking it down formal capital distribution routes, share buybacks, and under existing rules, using formal voluntary members voluntary liquidations, you'd be looking at 20% capital gains tax on things. But again, still not massively onerous considering how flexible this is. It does create the potential for double taxation charges, but the aim is you're not drawing everything out of this company all the time because you don't need it. If you need all of it that is within this structure for everybody, it may not be the right structure for you. That said, it is still probably going to be better. No, I'd have to question that. I was going to say it still would probably be better for residential buy-to-lets. That depends what you do, and it is an individual calculation circumstances. As a rule of thumb, if you are creating a new portfolio of residential buy-to-lets, I probably would be saying to you form a limited company and go that rate from the start, rather than individual names. If they're already in existing names, we would have to sit and do it. And yes, sit and calculating it, there is a charge for doing that. Summary. So, summary of a family investment company. Family investment company, succession planning with tax efficient transfer of wealth to future generations. That's the fundamental reason for doing this. Taking asset values out of your estate whilst being able to retain control of the underlying asset and the income flows that come from that asset without breaching the retention of asset rules that you would get if you tried to hold on to it in any other way. It can help protect assets. It can be an alternative to a trust. Again, if you've passed it out of your estate, even your golden share controlling it has a significant less value to it, which means in the event of a bad marriage, a divorce, drug addiction, gambling addiction, or anything else, you physically hold less, which means it helps protect it in those circumstances. It also separates a bunch of assets from other things, just like a limited company does in trading circumstances, meaning that if something goes wrong in your life, not everything can be got at. There are a number of benefits that accumulate wealth over time. Essentially, it's shielding wealth by taxing it at 19% as opposed to 40. It allows the existing founder to retain control, and it allows accumulation of wealth separately to things. There's quite a lot of offset you can put against it, but it is a complicated structure to set up. You will need professional advice to do it, and that does come with costs. To give an indication of costs, because we always get asked, CCM upfront costs for the tax work of even looking at a family investment company is £2,000. And then £500 per property. I've written it, but I would also say instead of property, per asset class that is being put, or per asset that's being put into this. So if you have 10 houses you're looking at, it's going to be £500 a house that we're going to have to consider to this. So you're looking at £7,000 of our fees. And other types of assets would be different. We would treat shares as one whole class. They wouldn't be between companies or individual funds or anything like that. We do have to do this on a case-by-case basis. You used to be able to obtain advanced clearance for this from HMRC. Advanced clearance is not obtainable anymore. We do tend to take a cautious approach to it, and depending on what it is, still try and seek some form of confirmation from HMRC where we can. That is covered by the upfront cost that we ask as a commitment charge. We also ask for an upfront deposit, non-refundable, for this, because a number of people have got us to do all of the work of setting it up, and then at the last second taken that work away and got their own accountants to implement it. Yeah, you can do that. We wouldn't encourage it. It doesn't feel right to us, but at least if we've charged the upfront non-refundable, our core time costs have been covered. Something you do have to bear in mind is stamp duty, particularly stamp SDLT. This will depend on the property values and will be charged at least, well, when the chancellor's existing holiday runs out, at least 3% on the whole of the transaction value if you're looking at transferring across property. Transaction values, stamp duty, transaction values, the has to be taken into consideration during it. The fundamental reason that I have seen for people not this is the stamp duty costs. It can be quite significant if you sit and calculate it. If you've got £1 million property portfolio and your average value means that you fall at a 5% stamp duty charge, you're looking at a £50,000 charge. Now, there are some mitigations to stamp duty, things you can actually seek to do. Partnerships are exempt from stamp duty. A partnership has to be a formal partnership, though, with a written partnership agreement, having filed an SA 800 for at least 3 years. We can help put that in place. You may want to sit a while. The thing I would always say with sitting a while is who the hell knows what tax changes will come. You could be sitting waiting and find that all of this is no longer able to be done. But it is a cost. You do have to consider it. Again, if you're transferring ownership of property, you will have to formally convey that property. You're looking at probably around £650 per property to do that. That is not to us, that is to a proper lawyer. We can introduce you to lawyers. We can happily work with your own, but if you are transferring property, it must be formally conveyed. We are not a fan of the beneficial trust companies that are promoted across the internet. Despite recent videos from some of the promoters of those schemes saying HMRC's manuals allow them, we don't see that as correct, and wouldn't support our clients going down that route. The ongoing costs of the accounts and the corporation tax have to be considered. Typically, we find that costs about £250 per property once you've moved it across, if you're doing those. If you are putting other assets into it, you will still need to support you have to have accounts and returns made every year. This is a limited company and it has to be filed on the basis of a limited company. There will be a cost to doing that. I would typically think about a £1,500 a year compliance charge from a high street firm of accountants. If you need finance to be arranged for either the stamp duty or any of the other fees, we can do that. We make a fee for that. If you have your mortgage, if you are moving buy-to-let portfolio across and have mortgages on them, you must tell the mortgage company. If you don't tell the mortgage company, you are committing mortgage fraud. By telling the mortgage company, it is possible that they will accept a novation of the existing terms. It is unlikely that they will. They will probably make you remortgage the properties. In remortgaging the properties, there will be a cost to you, either from your existing mortgage companies or from taking out new finance. And we typically see charges of around £350 per property as fees, plus up to about 1.5% being paid to brokers. The way I've written that slide, it sounds like we can do that for you. We can't. We can introduce you to appropriate people. I have had a question live of can you offset mortgage interest against buy-to-let portfolios within limited companies, and the answer is yes. You will see that again on the slides if you look at it. Section 24 does not apply to limited companies at this time, but again, all tax rules are subject to change. That is the whole point of incorporating properties, and in so doing at the same time allows you to come across an FIC and a family investment company. So there are some considerable costs to doing this. It can be beneficial. Certainly if you're doing this from the inheritance tax planning point of view, I still think this is extremely strong tool. You will have to take advice though. This is not a DIY. And advice can be taken from myself, Robert Newman. That I can be contacted at Carter, Collins and Meyer on 01706 860 255 or inquiries at uk-ccm.com. Our website is www.uk-ccm.com. Thank you very much for listening to this. I will just have a quick look at if there's any other questions I can answer live. Otherwise, the whole download and notes will be available on our YouTube channel. If you go to YouTube, type Carter, Collins and Meyer, please do subscribe. I pump out 2 or 3 videos a month on the whole. Last month's CPD I didn't put up on YouTube because having got to this point in the presentation, I realized I hadn't actually pressed record, so it didn't capture it. Schoolboy error, hey ho, is what it is. Think we've covered everything that everyone's asked for. Please do let me know if we can help. If you are a will writer and have clients doing this, you should be aware, and we disclose this to clients, but we do pay a referral fee for anyone sending us the tax work side of this. We tell the clients that we do pay a referral fee. We tend to pay between 5 and 10% of the value of our fees generated. That's our costs of it, for anyone sending us this type of work. And we are very happy to work with you. We do have a few materials we can give out if you're a will writer. They're the same materials we give to clients directly if you come to us. So if you're watching this as an individual and would like help with it, please do let us know. Thank you very much for watching. My name's Rob Newman, and I will finish at that point.